Denise and Stuart McPherson are award-winning real estate investors living in the Ottawa area and are the owners of SDMAC Properties, Inc. They are certified as real estate investment advisors and regularly provide coaching and advice to investors across Canada. Denise's teaching history has instilled a lifelong respect for education, and as such, they are both committed to helping people succeed. They use real estate as a means to create wealth through strategic investments in residential buildings, whether single-family or multifamily, and utilize innovative strategies, including the use of registered funds such as RSPs and TFSA funds to generate returns for others. And they'll give their contact information later. Very, very important to take notes on this one. Come on up, folks. Thank you.
Thank you. You know, I have to applaud all of you for still being here when it's so late in the day, so thank you. I know it's always harder for the speakers that are towards the end of the day, but anyways, like I said, thank you for staying in the room. Now, I'm short, so you're going to see me move around a little bit because I just feel like I'm dwarfed here behind this equipment here. So we're actually very excited to be able to share with you about the power of using RSPs to fund real estate. What we're going to talk to you about today is everything that we do personally. Everything we're telling you, we do. And that's an important fact, too, because that means if we can do it, you can do it, too. So these are strategies that you can put into place. But the one thing I will say, though, no matter what you do in real estate, always speak to the appropriate professional to find out if that strategy is right for you. Okay, that's one of the caveats I have there. So,
now, just to give this some context, today we're using the term RRSPs, but what we really mean is registered funds, because the strategies we're going to talk about today apply whether you're using a registered retirement savings plan, whether you're using an education savings plan, a RIF, a LIRA, or a tax-free savings account. The system works the same for any of these registered funds. So, when we talk to people about using RRSPs, the question is, why deal with registered funds? And the answer quite simply is, because they're available. There's lots of them out there. As a matter of fact, it's hard to get statistics on the current value of what is invested in Canada. What we have found is that there's somewhere between $1 trillion and $1.45 trillion in RRSPs. That's the fair market value of them. We know that there's more than $233 billion in tax-free savings accounts. Now, a lot of these are being held in large financial corporations who sell mutual funds, sell stocks and bonds, sell GICs, and the general public, for the most part, doesn't realize that there are other investment avenues, such as RRSP mortgages. And the neat thing is, if you're dealing with TFSAs, I mean, that's a relatively new product. It's only 10 years old. But the 2019 deposit amount is allowed up to $6,000, which means that a person could have as much as $63,500 sitting in a tax-free savings account, which is a really nice amount to make a mortgage.
now we get that question a lot about, listen, I have RSP funds. Can I use them for my own property or my own investment property, like my own personal one or investment property? Before we actually even mention this, you need to understand that there are different rules that apply for arm's length and non-arm's length transactions. So the difference between the two basically has to do with the relationship between the borrower and the lender. So in a non-arm's length, that just basically means that you are the borrower and the lender. Now, non-arm's length also applies to immediate family, so that by marriage is called non-arm's length, and also any relationship by blood, and we're talking about, you know, mother, father, brother, sister. Actually, it doesn't include aunts and uncles, believe it or not. And the other thing is, too, is by adoption, falls under non-arm's length. And also if you have a corporation that you own or have control over. So all of that fall under non-arm's length. Like I said, the rules are slightly different. Now, the question is, can you do RSP mortgages using non-arm's length kind of funds for these people? The answer is yes, you can. However, just know that the rules are stricter. What you're going to have to do is still qualify for your own mortgage through the bank finances, or the bank financial institution. You're going to have to be CMHC insured. There's more fees. As I said, the rules are just stricter. So in that respect, that's why we talk about the other one.
So when you're dealing with arm's length, Denise and I, being married, are not arm's length. But I'm not related to any of the rest of you. So all of us here in this room are at arm's length to me, which means that we can deal with arm's length mortgages, same as most of you are probably not related to everyone else in this room. So we have a whole room of people at arm's length. So everybody else is available to do an arm's length mortgage, and that's what we're going to be talking about today.
Now, before we talk about being a lender, I'm going to kind of give you a little bit of pre-warning. Now, when we first started, the very first private mortgage we ever did was actually using my RRSP funds that were in mutual funds. And I went to talk to my financial planner that, I explained to him this is what I want to do, and I have to move my money to a trustee that will allow those non-arm's length mortgages. And you know what he told me? You can't do this. You will lose your shirt. Oh, get this, it's illegal. And I'm going, what? Let me give you the translation. Please don't leave, I'm going to lose all those fees and commissions. Because guess what, with mutual funds, they make money whether you do or not. Okay, they do. So for us, it's been the best thing that we've ever done, actually, is moving our RSP funds out of mutual funds into mortgages, because it's allowed us to become lenders. And guess what? That means now we are the bank.
Now, earlier today, people mentioned private lending as a strategy. I mean, Timor was talking about it. She talked about some of the benefits, so I'm just going to quickly go over this. The reason why you might consider using your registered funds as a lender is you'll get an attractive rate of return. Your investment is going to be secured on real estate, on a mortgage. It's far more secure than stocks and bonds or mutual funds. I mean, I don't know about you guys, but we have had a horrible ride with mutual funds, which is why we got out of that market and got into real estate. The neat thing is with an RRSP mortgage, there are no hidden fees. When you're offered a rate of return, you're actually going to see that much money go back into your account. There's no commissions. There's no MERs, of management expense ratios that you'll get with mutual funds. So you actually get that. The other thing is that the way that we do mortgages, the borrower pays all of the costs. So that includes the legal fees for setting up the mortgage. That includes any administrative fees that are charged by the trustee in relation to the mortgage. So you as a lender get the real rate of return. And the other neat thing is you've got full control over the mortgage that you invest in. When you put your money into mutual funds or into stocks and bonds, you're dependent on either the fund manager or the people that are in control of the corporation to make the right decisions to earn profits and return things back to you. When you're dealing with a mortgage, you're dealing directly with the borrower. You have a chance to vet exactly what they're doing, what their project is, so that you're satisfied that this is going to return a profit and you're going to get your money back.
Now, the other thing is, too, with this is that when it's a way of investing in real estate without being a landlord, which is really great for some people. Now, for those of you who are hearing about RSP mortgages for the first time, I do want to tell you it is very much a CRA-approved method of investing your registered funds, okay? You can even look that up online. It is an approved method. So this financial planner that told me it was illegal did not know what he was talking about. So the one thing for us also is that when we became lenders and we lent our money out, we were helping other investors grow their portfolio. And finally, the light bulb kind of went on. And I thought, well, hold it here. If we can lend out our money helping others, we can become borrowers also, which is what we did.
Now, some people will ask us, why would I want to pay the extra amount and pay the higher rates of borrowing somebody's registered funds? Well, as one of our early mentors told us, it's the availability of money that's most important when you're doing a deal, not the cost. If you've got a good deal or a great deal, there's going to be enough margin in there to pay the extra cost of getting the money. But if you don't have the capital to do the deal, you're not going to make anything at all. If you've ever played Robert Kiyosaki's Cash Flow 101 game, you know this strategy. Because in the game, when you borrow money, you're paying 10% interest per month. That's 120% per year. And you can still get out of the rat race by earning enough cash flow. So again, the key here is the availability of money is what is most important.
Now, the one thing that you know is it becomes that much harder to borrow money from the banks for your mortgages. The rules have just made it like really difficult. And the thing is that banking institutions won't lend past a certain loan to value. And the other thing is too, is that if you're an investor that has a larger portfolio, they may not want to touch you at all. So the other thing is too, is when you're dealing with private funds, this is something that I love because you can structure it to be able to make more cash flow. And you'll hear me say one of the things we love to do is to be able to help other people. So we can structure these mortgages so that the investor has more cash flow. So it means that in terms of, a regular traditional mortgage, you're paying principal and interest on monthly. Well, on these other mortgages, you can do interest-only payments if you want, or you can do an annual payment with a balloon at the end. And that I'll explain a little bit more later. But you have that option and giving the investor, the borrower, that opportunity to have more cash flow in their project until the project is finished.
The other neat thing is when you're dealing with an RSP mortgage, it's a private loan. And what you can do is structure this so that your deal will increase your return on investment because you're using other people's money. So we're just going to talk about some of the strategies that we use when we use RSP mortgages. And the first one, some of you may be more familiar with this. We call it the equity takeout technique. And this is where you've got an existing property and you use a registered funds and RSP mortgage in order to access some of the equity that you've got in that property. Now, you can use that money for a number of things, but I don't suggest you use it to buy a boat or a cottage. And if you're not sure why, talk to your accountant, because he'll explain the importance of how you use the money that comes out of this. But it is a way to get access to funds. And let's just talk about a typical example. So let's say, for example, you want to buy a property and it's worth $400,000. Traditional financing, you're going to put 20% down, so that's $80,000. Let's assume that over the next 5 years, the property appreciates about 3% per annum. And after 5 years, you decide to sell the property. Well, you would sell the property for $464,000. Now, that's a profit of $64,000. And just to keep this really simple, I'm going to ignore cash flow. I'm going to ignore mortgage paydown. We're just going to deal with appreciation. So a profit of $64,000 is a return on your investment of 80%, which is 16% per annum. But if you use some leverage, which you can do with a second mortgage, still the same purchase, $400,000. You put a first mortgage at 80%. You put a second mortgage of $40,000, a 10% second mortgage, paying 10% interest, for example. Same 5 years passes, still a 3% appreciation. You still sell for $464,000. You pay the cost of the second mortgage, which is $20,000. Your profit on this is $44,000. But because you've only got $40K in, your return on investment is actually 110%, which is 22% per annum. And the neat thing is, because you did this deal and you only had $40,000 in the deal, the other $40,000 you had in your bank account can be used to either do a similar deal or to do something else, so your ROI can even be higher than that.
Now, we've been able to use this same strategy about using second mortgages with rent-to-owns. And just to give you an example of one that we've done is that with the tenant buyer, we got a 10% option payment right from that tenant buyer. And then we put in a 10% second mortgage behind. So how much money did I have in the property? Basically, it was a no money down deal. And the thing is, yes, we did close on it. And we had our returns were infinite on this one. Actually, we made lots of money on that particular property because at that point too, there was lots of problems with it, but we worked out through the problems. We were able to close it, and that's the beauty of doing some of those rent-to-owns and being able to help people get into their own property. But being able to use this kind of strategy really, really helped. Now, The other one that we like to do a lot is what we call the bank avoidance technique. We just talked about second mortgages, which is when, for anybody who knows about RSP mortgages, they usually think about second mortgages. But what we do is we tend to use them also for first mortgages. And what we do for a lot of the properties is we do 100% loan to value. People go, what? Yes, 100% loan to value. But the only time that that works is when you're able to bring a lot of value to the property so that where you bought, the purchase price, there's a very big gap with the after repair value. That's the only time that you should look at a first mortgage and a purchase of a property, because it's a short-term strategy when you're using it as first mortgage. Because when you're thinking long-term, a buy, rent, and hold, and if you're buying a property at market rates with a first mortgage, those payments are not going to be sustainable. It's just not. It's just too expensive. So you got to be very careful here. So as I mentioned, these properties, there has to be that gap there. So really what you're doing is you're buying a property at a really good, let's say you're buying it from a motivated seller, you got a really good low price on it, and then what you're going to do is fix it up. You're going to renovate it. And this is where you bring all of that value, is that like that buy and fix phase at the beginning. That's where you create that big value. And once you've done that, at the end, you can sell it if you want and make a profit, or you refinance. And when you refinance, you get a traditional mortgage, the 80% loan to value, let's say from the lending institution. But that also means that depending on how much renovations you put in, you could have little or no money left in the project. And actually, Nick talked about one of them when he refinanced, that there was, basically it was all paid for and the rest was gravy for him. So these things happen. And when you refinance it, then you rent it out, which is your typical buy and hold strategy. And as you know, the longer you keep real estate, the more powerful it becomes. And this one, just the picture I showed you, when we did that one, that was a secondary suite that we had done in this property to raise the value and put 2 units. And this was, as you can tell, we're at the demolition phase here on that one.
When you're dealing with an RSP mortgage, there's a number of things that you've got to do in order to make sure that the property and the plan qualifies. We're going to talk about this from the aspect of the borrower. But if you want to be a lender, you're basically using the same rules. You're just looking through the telescope from the other end. The one thing as a borrower you want to make sure is to satisfy the lender's due diligence. Because the lender is going to want to know that you've got a plan in place so that you're going to pay back the money that you've borrowed on time. You're going to pay back the amount that you've agreed to. And as Kevin O'Leary always says, he likes to send his soldiers out and have them come back with friends. So what you want to do is make sure that you have lived up to your obligations and gotten this money back to the lender appropriately.
Now, in terms of the value of the property, that's probably one of the most important things here for a lender, because it's his security in case the borrower does not meet their obligations. So this becomes very important to be able to prove the value of that property. It would mean possibly getting a comparative market analysis done. It also could mean getting an appraisal done to be able to prove that value. And this is, again, very important because they want to get paid back at the end. The other one is they're going to want to know how you're getting in and out of that project. Again, their concern is they're going to want to get paid back once the money, once the project is finished. So you, as an investor or as a borrower, have to have a very, very clear strategy how you're getting into the project and how you're getting out of the project. And we've had people come to us and they're so wishy-washy, they don't know what they want. We don't even look at those projects for lending on. It has to be very clear. If you don't have a good feeling about the project, don't even consider it, okay? Now, the other thing that you're going to want, or the lender's going to want, is going to have to feel good about, the experience that the borrower has. Now, from our perspective, we normally don't loan on first-time investors. And if any of you have ever had your first property, that's usually the one where you're learning the most, and it's usually the one where you're going to make your mistakes. Well, guess what? Don't make your mistakes with my money. So the only way we consider it is possibly, and I say possibly, is if that first-time investor was working with a very experienced investor. The other thing is to look at how much equity is in that property. Now, when you're looking at a first mortgage, that the trustee will not allow more than 100% of that loan to value. Now, traditional financing sometimes will actually register a mortgage that is 110% of the property. You can't do that with RSP mortgages. That's the maximum that is allowed, okay? Now, if you need to do renovations, guess what? Find the money elsewhere, because you're not going to get it through this type of financing. So it is possible to, like I said, register a mortgage up to 100% of the value. Now, you know, they're going to want to know that you're a good credit risk, right? They want to get paid back. And again, I go back to the exit strategy because, again, this is the most important part. That lender wants to get paid back. Now, if you are refinancing a property, you have to look at also, will that borrower be able to qualify for a mortgage at that higher amount, you know, when you refinance? If you're doing, you're selling the property, is the value of the property, is the market going to support a higher priced house in that neighborhood? So when you're doing your due diligence and you're getting all of that information on the property, these are some of the things you have to kind of look at.
One of the things that we always take a look at is the importance of managing risks. When you are dealing with a lender, especially a lender who's not a sophisticated investor, you've got to make sure that they understand that no investment is guaranteed, that there are risks involved in any strategy, including this one. However, one of the things that we do is we make sure that the person we're talking to understands that we're sophisticated investors with a lot of experience. We understand their risks, and we are going to take steps to mitigate those risks. And we'll even describe some of the risks and show the lender what we're going to do over the course of the project to make sure that at the end of the day, we're going to show a profit so that we can pay them back with the amount of money that we want, and we show them how we're going to keep things on time.
Now, one of the things is that if you ever plan on doing a secondary mortgage, make sure that the primary lender will allow secondary financing. There's a lot of the banking institutions right now that won't. So when we go looking for a mortgage with our broker, we say, please look for a mortgage that will allow secondary financing if we want to put it there. I'm not saying we will, but if. Like I said, some of them don't allow it, and most banking institutions won't let you close on a property using secondary financing on the same day, okay? So you just have to be careful. Know what you're working with. That's the bottom line. Know what you're working with.
One of the other things that you need to do is take the appropriate steps to maintain the value of the property. Now, what I mean by this is, if you're doing a fix and flip, for example, make sure that you are going to use the appropriate materials and the quality of materials in order to maintain the value that you have expected as the after repair value. If this is a property that you're putting a second mortgage on, that's an existing property that has a tenant, make sure that you've done a really good job on screening your tenants, and these are tenants that are not going to damage the property and devalue it. So do your own due diligence and take the steps to maintain the value of the property that's under mortgage.
Even in a declining market, you can actually use this strategy. The only thing you have to be careful of here is don't over-leverage the property. We would never consider 100% loan to value because you want to, well, you really want to use a loan to value and leave some equity in the property. You don't ever want to be stuck in a situation where you can't pay it back because all of a sudden, you know, the market has decreased a bit. So just be careful on that.
Now, as in any private lending situation, one thing you as a borrower should do is good planning, is make sure you've got a contingency plan in case your lender needs an early exit. Things happen in people's lives. It doesn't happen often. But if your lender needs to get out early, one thing you could do is play hardball and say, no, we've got a contract and we've got a term and you've got to leave your money in for the term. But what that's going to do is reduce significantly the chance of you doing business with that person again. So it's always better to be constantly networking, have a bunch of other people so that if you have someone that needs to get out early, you've got other lenders that you can go to try to replace them on the mortgage.
It's at a cost, mind you, but it can be done. Now, when we're looking at RSP mortgages, what you're looking at is you're borrowing funds from a private lender. You put a mortgage on the property, and then when the property sells or refinances, then all of that money goes back into the RSP account holder. Because a lot of people think, well, where does the money go? Everything goes back into the RSP account, okay? The one thing you have to remember is you are borrowing that money. You're not taking any money out. So there's no tax consequences or anything like that. It's still tax deferred. Everything still stays within the RSP umbrella. So that's the one thing you have to remember here, okay? You're only loaning. You're not pulling out money. So any property that you're going to put a second or a mortgage on, or RSP mortgage, is done on a property. It's done by a lawyer, first of all, on a property in Canada. People always say, oh, can I use it in the States? No, you can't. Remember, it's a Canadian product, so it's mortgages for properties in Canada, okay? And the thing is, you have to look at also is that mortgages can be in first, second, or third position. And I always like to ask this question here. I want you to raise your hand if you had the funds, would you consider a third position mortgage? Raise your hand if you would consider it. Okay, so we have about 12, 15 people in the room, okay? Let me put it a different way. The property is worth $700,000. The first mortgage is $350,000. The second mortgage is $75,000. The third mortgage, what they're asking for is $50,000 so they can finish another property elsewhere. I want you to raise your hand now. If you had the funds, have you changed your mind? Would you consider doing this as a third position mortgage? Raise your hand if you do. So it's to prove a point that each mortgage is totally different. Look at them individually. Because yes, when you're looking at the third mortgage, you go, oh my gosh, they're so over leveraged. Not necessarily. If there's a lot of equity in the property, you could be super secure in that mortgage. And the reason I use that example is we've done those mortgages in exactly that same amount that I just told you about. And the one thing though, there's a lot of trustees that will not do third place mortgages. So again, you have to do your homework to find out what is allowed, not allowed. And again, when you're doing stuff like that, any mortgage, you have to look at the loan to value. You have to look at the project. You know, supply and demand here means a lot too when you're working with mortgages. The one thing that I absolutely love here is because we talked about that the interest rates are not tied to the bank rates, which means that rates for private mortgages like this have a different range. So on a first mortgage, what we typically see is about 8%. Now, yes, I've heard people say, yeah, I got 6, but they had to pay 2 points. So guess what? 8 is about the average that we see. I've seen 10, but usually 8 is where we see right now mortgages in the private lending for first mortgages. For second mortgages, what we tend to see is anywhere from 10 to 18. Now, I don't mind telling you, if you're going to pay 18% for your mortgage, or if somebody approached me and said, I'll lend you money at 18%, I say, thank you. There is so much money there, as Stuart explained a while ago. There's so much money out there. There's no reason for you to be paying 14, 16, 18% for secondary financing, because that's what it would be if you're looking at those rates. So there's just a lot of money out there. And the thing is, we're not going to get into this, but even Nick had touched about networking. That becomes super important too. So those interest rates, like I said, are negotiable in there, but this is kind of what we see right now with mortgages. Now, flexible repayment terms. This here to me is such a powerful tool. I love it, I love it, I love it for creating win-win scenarios. Because when you're talking about the repayment terms, you can structure it again for the benefit of your project, and that's what it is. Remember I told you that we like to help, investors? So imagine here in terms of repayment term, let's say you could do stuff like, interest only, which we talked about. You could do the P&I, like in terms of monthly payments. You could do the principal and interest. And the one that I prefer, and is the one we tend to use mostly, is an annual payment with a balloon at the end. Now, this only works when it's the mortgage is more than a year. And the reason I say that is because a trustee will allow that deferred payment of the interest at the end, but they will require a minimum of one payment per year at 3%. That's what they've set it at right now. So imagine if you're borrowing on a secondary financing, let's assume to make it easy, 10%, okay, on a secondary mortgage, that is 5 years. So the first year, all you get to pay as the borrower is 3% for that year. So year 2, you pay 3%. Year 3, 3%. So you just pay 3% per year. So imagine that cash flow that you're able to keep and be able to utilize to do whatever it is that you're doing with. At the end, whatever interest rate that wasn't paid, so it's 7% per year, was not paid yet. So that gets paid at the end with the principal. So that's what we call an annualized payment with a balloon payment at the end. So imagine now, at the end of 5 years, you're either, because your term is up, you're either refinancing or you're selling. So now you have that nice chunk of cash to be able to pay it out. So.
Okay, the way that we do these mortgages is that the borrower pays all of the costs. This is one of the reasons why we find it easy to find lenders, is that we make sure that we pay all the costs. So that will include legal fees, that'll include the trustees' administrative fees. And one thing that I just want to mention is be careful when you choose your lawyer, because not all lawyers are experienced in doing private mortgages, and many of those lawyers are not experienced in doing RRSP mortgages. There's 2 lawyers in this room that have got experience in this, and they have been a godsend to us.
Why don't you raise your hand, because we don't mind showing you off. So we've got Babette Turner here, and we've got Leslie Kirk in the corner here. So these are 2 lawyers that we've used.
And the other thing that I'll mention to you is that if the mortgage is worth more than $50,000, each side, the borrower and the lender, each side need a lawyer. So there may be a few extra fees in that, but as we said, it's worth it.
One of the things that we do, we love to do syndicated mortgages. Because we do a lot of first mortgages, and usually that's a larger amount of syndicated mortgages, it just means that there's more than one person on that mortgage. And I like to use the small s for syndicated, not the large S, for syndicated that's been hitting the news negatively because it has to do with these big developments of big condo buildings. That's not what we're talking about. That's why I say it's a little s, okay? It just means more than one person on the mortgage. So we've been able to do first mortgages, let's say what I told you, 100% loan to value. So let's say one is $325 or $325,000. Then what we've been able to do is use 3 investors. And what I love here is you're able to mix them up. Out of those 3, what we did is one had RSPs, the other one had TFSAs, and the other one had cash. Yes, you can use cash for mortgages, okay? Even though we talk about registered funds, you can use cash. So the beauty of here, where there's more than one person, the lawyer will actually just calculate the ratio for each person and make sure that that's reflected in the mortgage. So this here is a godsend to be able to do this small s syndicated mortgages.
So one of the things that we want to do right now is just sort of wrap this up. The benefits of RSP mortgages: using other people's money increases your return on investment. You as a borrower don't have to worry about bank qualification. You get access to more property without bank or lender limitations, and you can help others by giving them a much better return on their retirement planning than traditional products. The one thing that I want to remind you is that private lending works as long as it's done properly.
And for us, this is something that we have been doing from the get-go. As a matter of fact, we did an RSP mortgage before we ever even invested in our very first property. We started with that. So we've been growing a mortgage portfolio alongside our real estate portfolio. And we've been doing, both of them. And then from a borrower point of view, is you're actually being able to increase your portfolio, you're being able to increase your returns, and from a lender perspective, you're able to grow your retirement portfolio. And because by growing your retirement portfolio, no matter if you're using TFSAs or if you're using RSPs, under TFSA, you're actually growing it in a tax-free environment, whereas if you're using RSPs, you're doing it in a tax-deferred environment. So, I mean, we appreciate your attention to this today. Now, the one thing I want to tell you, if ever you wanted to have more information how you can become a borrower or a lender, we can help. And the other thing is, too, is we're going to be providing, or we're going to be offering a course in the near future on how to use RSPs, that power of RSPs. And if you're interested, we just have a sign-up sheet at the back that when we're ready, then we'll just be able to let you know. So there's no commitment or anything, it's just an interest at this point. So other than that, we thank you so much to you for your attention for today, and hopefully you've learned lots from this session.
Thanks so much.
Thank you.
All right, thank you very much, Denise and Stuart. So on behalf of Tony and Sue, this is a certificate with permission to lend out my wife's RSPs. She has all the money, so that's all I have to say. Thank you very much. That was great. Thank you.
Thank you.
All right,
Thank
great.
you.
Thanks, guys.
I'm just going to grab my water.
Yeah,
Thanks.